Hi, and welcome to this latest video on computational finance. My name is Gregor Weiss. I'm a professor of finance here at Leipzig University. And in this latest video, I want to continue the presentation of the very basics of Markowitz's portfolio theory. And the next ingredient we need to understand what happens in portfolio theory is the efficiency as used by Markowitz, and that is usually employed in portfolio management. Now, we need to find out which portfolios are efficient in the sense that if we are given two portfolios, the one is always better than the other one. So it's not like it's better or worse in one respect and better or worse in the other, but actually it's always better, or at least it's not worse than the other. So this is Markowitz efficiency in this context, and by that we mean the expected value variance efficiency, which means if we are given two portfolios, A and B, we will prefer A to portfolio B if A has the same expected return as B and a lower variance, or in case both have the same variance, it has a higher expected return. So our two metrics are, again, as in the previous videos, expected return, the expected value of the portfolio return, and the variance or standard deviation, or in this context we call it volatility, of the return of the portfolio. So one metric has to be the same, and the portfolio that is efficient has, for example, then a lower volatility, a lower variance, or a higher expected return, or vice versa. So we have to look at both metrics, and the portfolio A, for example, has a higher expected return and the same variance, or A has the same variance and a higher expected return, or the same expected return but a lower volatility, a lower variance. In the case of two securities, if we are looking at two stocks, for example, the efficient edge or the efficient frontier of the optimal portfolios, according to the above given definition of Markowitz efficiency, is geometrically given by the upper branch of the space of possibilities, M, and starting at the minimum variance portfolio. So usually it will look something like this. Now we will start here at the minimum variance portfolio, and then the efficient frontier goes up. Because why? If, for example, we have something that looks like this, and we are looking at a portfolio that is located here, then of course we can always go up and get a portfolio that has the same volatility, the same variance, that's the x-axis, but it has a higher expected return. So all of these portfolios that are actually on this lower part of this hyperbole, all of this is inefficient. They are all dominated by portfolios on the upper half of this, what it has become famously known as the Markowitz eggshell. So this is the case for rho smaller than 1, because in this case we have a curve or a hyperbole. So these are the achievable portfolios in case we have three securities. If we combine A and B, you can see we have this dotted line here. If we combine A and C or B and C, we always get sort of this eggshell, this hyperbole. Then, of course, all of these are inefficient. We've just talked about the efficiency here. And if we now combine three stocks, we actually get this loop, this curve. And of course, in the sense of efficiency, we have to start with the minimum variance portfolio and go up, and we get this frontier of efficient portfolio, or just the efficient frontier in portfolio theory. Formally, mathematically speaking, the portfolios on the efficient frontier can be determined algebraically as following. We take a given constant expected return, and then it's a minimization problem. We minimize variance or volatility, and our two conditions that we have to condition on in our optimization program are: first, we have to set one of the metrics constant. In this case, we set the portfolio expected return constant to, let's say, 5%. And we also require that all the weights that we use in our portfolio add up to 1. And this minimization of the variance can be made, for example, with the help of the Lagrange method. And later in the lecture, we'll see how this can be done in practice using real data in MATLAB. But for now, it suffices to see and understand what efficiency means in the context of portfolio management, and that this actually relates to a very simple optimization problem where we need to include some conditions and we can't minimize or maximize both at the same time. So in practice, actually, we also have even more restrictions. For example, portfolio managers, especially insurance companies, might have some restrictions coming from regulators. They are not allowed to put all policyholders' money, for example, into high-risk derivatives. So we have restrictions in the asset management of insurance companies. You might have some internal rules, meaning that you're not allowed to invest in too many asset classes, in too many assets, but not too few. And the efficient edge of the space of possibilities finally shows an intuitively plausible principle. Risk and return stand in a positive functional relation to each other. If you want a higher expected return, you have to accept a higher risk, and vice versa. So this is something that is quite intuitive and natural, of course, in practice, but you can easily see this on the slope of the efficient frontier of portfolios. And from the determination of the efficient edge, we can then tell that numerous questions of portfolio theory are mathematically solved by optimization tools. We need to optimize a function, either variance or expected return, and we have several restrictions and conditions. So basically, this is convex and non-convex optimization under constraints. So constraint optimization is the tool we need here, and this is where basic portfolio management, and this is just Finance 101 or Corporate Finance 101, actually evolves into computational finance, because we need modern and sophisticated mathematical tools from optimization to do this in practice. So next, we'll start with our first real topic in numerical analysis, and we'll start with the numerical solution of linear systems, but this is done in the next video. So thanks for listening, and see you in the next video.